liquidity ratio, we have the current ratio. We have the current ratio. We have the asset test ratio, which is also called the quick ratio. We also have the cash ratio. We also have the cash ratio. So, oh, I'm muted. Can you all hear me now? I think I was having network glitch at some point, but I believe you guys can hear me now, right?
Yes, sir, we can hear you.
Okay, good, good. So yes, so that is that. That is that. So we have the asset test ratio, we have the efficiency ratio as well. The efficiency ratio is the third ratio, and it talks about how efficient the business is utilizing its assets to generate revenue. You understand? To generate revenue and also to be able to control and manage its liability. So we have the inventory turnover, we have the receivables payable days, receivables days, we have the payables days, and the likes. So then the leverage ratio compares the equity with the debt of the company. So when we talk about debt ratio, we're talking about interest-bearing debt. So we're trying to compare the revenue with all the interest-bearing debt. So yes, so that is that. Then for please, can we move to the next slide quickly? Okay, can you go? Can you? Okay. I think from here I would be presenting my screen for us to be able to have this practical session. Yes. So we have data visualization and storytelling. So we have tools that we use for carrying out financial analysis. We have Microsoft Excel. We have Power BI. We have Tableau. We have SQL. Yes, SQL is used by financial analysts. Yes, and also financial data analysts. So yes, so we have different financial analysis tools that we can use, but the most popular is Microsoft Excel. So we're going to be using Microsoft Excel in today's lecture. Yes, let me open my Excel. Just give me a minute. Wow, this is not opening. Okay, I'm sorry. I'm trying to present my screen where I have my Excel. Please just give me a minute. Okay, good. Okay, can you guys all see my Excel? Please let me know if you can all see my Excel. Maybe the host can stop sharing his screen so everybody can see my screen. Please, I need your feedback. Can you all see my Excel?
Yes, you can see it.
Oh, good, good, good. So yes, so this is Microsoft Excel 365 is the online version of Microsoft Excel. And it has most of the updated features of Excel. So yes, but if you have Microsoft Excel installed on your laptop, you can still use it. At least we are not going into the advanced aspects tonight. So yes, so all Microsoft Excel, whichever version you have, should be able to work with what we are doing tonight. So this is I want to walk you through what's the practical aspect of financial analysis. So we've talked about um, what financial analysis entails. We've talked about different ratios. We've talked about the pay of financial analysts. And one thing is that, okay, let me just say this before we go into the practical aspect. With the innovations of AI, technology, and the likes, AI is taking over a lot of jobs. Yes, AI is taking over so many jobs. So, like preparing the financial statements is something that your accounting software can do, and it can be automated such that um, artificial intelligence can handle that aspect. But the financial analysis aspect, um, you know, is something that makes you different from other accountants if you are here. And because this skill is actually needed globally, is in high demand globally. Yes, financial analysis is in high demand globally, but we only have few people who have the skills. Yes, who have the core skills of financial analysis. And these few people, they are actually earning much. As you can see in the first presentation I shared with you, yes, so that is that. So now, there are a lot of opportunities involved, and as I've said, financial analysis is a career path that you can build on. So even though there are so many things involved, but I'm just trying as much as possible to explain um, everything in detail so that everybody can understand why we are here. So yes. So yes, yeah, we have a profit statement. We have a profit statement. We have the revenue, the cost of sales. So this This is like cost of sales, actually. Cost of sales. Then we have the selling general admin expense, research and development depreciation, unusual expense, other operating expense, operating profit, interest expense. So this is like, if you look at this, a lot of people will say, this company is doing well. The revenue is 14 million. The revenue is 14 million. Now, can I get any feedback from one person? Can you just, in your own words, can you just tell us about the performance of the company you are seeing here? Is the company doing well? Is it not doing well? I just need a feedback from someone that is very confident. If you are so confident of yourself, can you raise up your hand so that I can, or you can use the chat? Yes, the reason why I'm not allowing that is because I was hearing some noise and I don't want us to be hearing noise. So if you want to talk, you can raise up your hand. I'm going to unmute you. I guess the person that typed as AK wants to talk, right? If you want to talk, just raise up your hand so that I can allow you to talk and answer this. So in your own word, I would want you to tell us, how do you see this company's performance based on what you are seeing on the screen? Is this company doing so well or they are not? Yes, anybody? I'm not seeing any hand, actually. I'm not seeing any hand. So who is talking? Is anybody talking? Oh, nobody wants to say anything. Nobody's raising up his hand. Okay. So, all right. So
The
anyway,
company is doing well
oh, okay, good. The company is doing well.
because
What make you think the company is doing well?
at least they
Can
are
you just say one or two things that make you think the company is doing well? Yeah.
because the revenue is more than the cost of sales, and they are at the profits. They're not making loss.
Oh, okay, okay, okay. All right, good. Thank you so much for that. That's a very good contribution from you. Thank you, finance manager. Even though I would have loved to know your name, but I'm saying finance manager. Yeah. Yeah, we're going to start with the first ratio, which is the gross margin. So the gross margin, the formula for calculating the gross margin is, so we're starting with profitability ratios. The formula for calculating the gross margin is your gross profit divided by your sales. So we want to see gross profit divided by sales. So we just take our gross profits. We take our gross profit, which is here gross profit divided by sales, then divided by sales. So now on Excel, you have, anytime you want to impute a formula, you go to the, let me start again. You go to the tab where this tab is where you want the formula to appear. So if you want to impute formula on Excel, you start with the equal sign. If you don't put equals to sign here, Excel cannot recognize that you want to type a formula. So equals to, I say that gross profit, look at what is here. So this is telling me what is on the formula bar. So it's telling me the formula I'm typing on the cell. So this is gross profit. Gross profit is C8. So on your Excel, you have so many cells. So all these things you are seeing here, like boxes, they are cells. We call them cells on Excel. I'm just trying to explain from scratch because I understand that maybe majority of us may not be familiar with Excel. So I'm trying to ensure that everybody get the benefit from this class. So this cell are represented with alphabet and numbers. So each cell has rows and columns. So the rows are represented with numbers. So like here, we can see row 1, row 2, row 3, row 4. So this cell is on the 8th row. And the columns are represented with alphabet, letters of the alphabet. We have A, B, C. This cell is on the C column. And that's why this cell is actually C8. Is on column C and row 8. C8. Then divided by revenue. Your revenue is on row C5. Let's just use total revenue. Then press enter. Now, the moment you press your enter, we can convert this to percentage. We can convert this to percentage. So this is showing us that the gross profit margin is 44.03%, approximately 44%. Approximately 44%. So we have our operating profit margin. Operating profit margin is actually operating profit divided by sales. Your operating profit is your earnings before interest and tax. Now, if you say margin, margin means divided by sales. Please take note of that. Margin means divided by sales. So your earnings before interest and tax divided by sales. Your earnings before interest and tax is your operating profit divided by, so that is, what cell is this? This operating profit that I highlighted, what cell? Can somebody help me quickly? If you are following, what cell is this? Anybody?
C14.
C14, good. Good. Yes, that's correct. C14. So C14 divided by revenue. Revenue is on C6. Yeah, equals to. Now, this is 22.04%. Your operating profit margin is 22.04, approximately 22%. Then your net profit margin is actually net profit over sales. Net profit over sales. Net profit over sales. That is 16.63%. So now, this company's net profit is 16%, approximately 17% of the total profits. So this is how you do what? Vertical analysis. So this is what we call vertical analysis. Vertical analysis is when you are comparing a line item in the financial statement with other line item. And in most cases, you use the highest figure to compare. The highest figure in this profit or loss is what? Which of these figure has the highest? Anybody? Which of the figure has the highest figure?
The revenue.
Good, thank you so much. The revenue has the highest figure. The revenue has the highest figure. So the revenue is what you are using to compare, and that's why you are using the margin. So that is what we call the vertical analysis. Now, that's for profitability ratios. Let's quickly look at our efficiency ratio. Our efficiency ratio, we have the tax ratio. Tax ratio is actually tax expense divided by earnings before tax. So we say equals to tax expense, which is here. This is your income tax expense divided by earnings before tax. This is earnings before tax is your profit before tax. So you're comparing your tax expense with your profit before tax or earnings before tax. Your earnings is also called profit. So that gives you 24%. So it's telling you that your tax is 24% of your profits. So the profits you made, you are paying tax of 24% or approximately 25% of it. So which means that approximately 75% is what goes back to the business, but 25% is paid to the government. So that is what the tax ratio helps you to do. It's helping you to check how comparing your tax with your profits. So that is that. So then for solvency ratio, we have the interest coverage ratio, or which we also call the interest cover. And that's your earnings before interest and tax divided by interest expense. So you are looking like, okay, how many of your interest can you find in what's it called? How many interest can you find in the profits? So that is, you are dividing the profit divided by interest expense. So is earnings before interest and which is your operating profit divided by interest expense. Wow, this is going to be very huge. Yes, I know. This is huge. This is huge. This is massive. This is it's telling us that your interest expense is 2 times that you can find in your profit of the figure. Very, very low. So that is what we call the vertical analysis. Let's quickly go to the horizontal analysis. Now, for the horizontal analysis, you are comparing different things. You are comparing years, different years. So for vertical analysis, we have let me go back to the vertical analysis slide. So we have just a single year and we have only one item. Yes. We have only one item. Yes, we have only one item for vertical analysis. While for horizontal analysis, you have several years. You are comparing several years. So that is the difference between vertical and horizontal analysis. So for, okay, oh, wow, these figures are here already. So now, yeah, now, at times, I'm going to remove all these, I'm going to remove all these figures so that we can be able to demonstrate this better. We need to be very, very practical. So I'm only going to leave the figures are colored in blue. So those are the inputs. Those are the inputs. The ones in black are as you can see, everything here are in blue. So these are the inputs. So everything that you are seeing in blue are the inputs. So we have the revenue. So the total revenue, we say, oh, the total revenue is the sum of, okay, we only have one revenue. So we just say equals to this. Now, we can copy this by pressing Ctrl C, then dragging it here and pressing Ctrl V. So what this does is that it helps us to be able to copy this formula that we have here. So yes, that is total revenue is this. It's still the same figure. So, but what we did, we say equals to C5. That is, this revenue is what it should give us. So exactly. Now, anytime you copy, what did we notice? When we copy this and paste here, so it's, if you check, you don't have C5 here, you now have D5. So it automatically shifts the row, the column from C to D, but still maintain row 5 as the stuff. So that's how Excel formula works. That's how Excel formula works. Let's quickly do the gross profit. So the gross profit is going to be our revenue minus total revenue minus cost of sales. Cost of sales Sorry, this is supposed to be cost of sales. Yes, cost of sales. I think I changed the sales to revenue. That's why it's giving me cost of revenue. All right. So yeah, it's telling us that the gross profit is this figure. So just in case you are the one preparing these financials and you have the revenue and you have the cost of sales, you can use the Excel formula to get your gross profit. What you need to do is say equals to revenue, which is this, minus cost of sales, which is this. Then you press your enter. So it's telling us that 2,065,000 minus 95,000 is 1,140,000. Now, I would like to say this: you don't need to use calculator while you are using your Microsoft Excel. In short, I was in a particular office one day and I saw somebody using Excel and the calculator was beside the person. I was like, are you kidding me? So you don't need a calculator with Excel because Excel itself is a calculator on its own. So it does all the mathematical computation for you. Yeah, Mr. Toby, I can see your smile. Yeah, it was very, very funny. And I was like, are you kidding me? Are you serious? So yes, you don't need calculator actually. So you can just copy this and paste. You can copy this and paste. Now, before, not somebody might be saying, okay, let me take this formula again. Yeah, press equals to, press this minus this is actually a waste of time. You don't need to do that. So just copy this by pressing Ctrl C, then drag it down and paste by pressing Ctrl V. It's going to copy it. So this is how you work smart. You need to work smart. So the moment I ensure that this formula is correct, I can just copy it and paste it here and every other thing will be correct. So yes. So our operating profit is going to be gross profits minus the sum of all these expense, research, depreciation, unusual expense. So I just say that equals to minus sum, okay, equals to the gross profits minus the sum of these down, and I press my enter. So this is telling me that my operating profit is this. So I don't need to type my formula again. I will just copy and paste by pressing Ctrl C to copy and then Ctrl V to paste. Yes, and that gives me my profit, operating profit. Then profit before tax, we say is equal to what? Operating profit minus interest expense gives me our profit before tax. I can just copy this and paste. So you can see that this is how to work smart. Now, it's not about doing a lot of work. It's about doing what you need to do, spending little time to work, and what you are getting is top notch. So instead of spending hours to work and you're not getting any results. So yes, it's not how long, but what you're able to do within the shortest period of time. So now profit after tax is going to be profit before tax minus income tax. Yes, you already have that. So you just copy and paste so that it can give you the figures here. Now the net profits, extraordinary items are 0. So it's going to be this minus 0. This is, which is still the same figure. Yeah, it's still the same figure. So now, what did we notice about this company? Year 1, year 2, year 3, year 4, year 5. What did we notice about the company's performance for the 5 years? Can anybody just talk? We've not started analyzing, but just looking at the financials, what can you notice?
There's a
It's
constant
progressive.
increase in income, yeah.
Sorry?
It's progressive.
It's progressing. So what's the progress? Is it
Both
is
in
it a
terms
linear
of
progress? Is
revenue,
it
in terms
exponential
of
progress? Is
expenses.
it a linear growth or an exponential growth? Is it a linear growth or an exponential growth?
Linear growth.
Okay, it's a linear growth. So what does linear growth means?
Just gradually.
And what does exponential growth mean?
Exponential could be like double times 5 times 3. Just
Okay.
moving exponentially.
Okay. So, but the point is, this company is growing. If you look at the first year, they made a profit of 308,000, but in the second year, they made 579, which is almost times 2 of what they made in first year. And in year 3, they made over 1 million, which is almost times 2. So the profit of the company is growing, the revenue is growing. At the same time, the costs are growing. So we need to do horizontal analysis by saying, okay, what was the gross profit of the company, the ratio? I think I need to put these in percentage. Yeah. So gross profit ratio is going to be the gross profit of revenue, total revenue. So you just take the figure. This is 55.2. Now, in which year is does the company has a better gross profit? In which of the years does the company has a better gross profit? Anybody? Yes, anybody quickly. We don't have all the time, please. And I want us to cover a whole lot.
Year 5.
Year 5. Yes, I know a lot of people will say year 5. Why is it that we are not hearing the female voice? I know there are several females in this room, but they are just quiet. So females, give us the vibe too. Let's hear your voice. I know females are very, very intellectuals. Yeah, so let's feel you also in the class. Okay, let's check the gross profit ratio. Let's see if truly year 5 gives a better gross profit. But to my surprise, year 5 has the least gross profit margin. Year 5 has the least gross profit margin. Now, gross profit margin is not looking at the number. It's looking at your gross profit is how many percent of your revenue. That is what the gross profit margin is testing. And you're like, okay, in year 1, your revenue was 2,065,000. Your gross profit was 1,140,000, which is above 55%. Which is above 55%. If you had the same gross profit margin in year 1, your gross profit will be higher than 6.5 million. Yes. So it means that even though your revenue is increasing, but you've not been able to manage your cost of sales. Your cost of sales increase outweigh the increase in gross profit. So that's another thing you need to talk about. So there are ways you can also get more profit by minimizing the cost of sales. So that's actually the point I'm trying to raise there. So even though the gross profit is better in year 5, but if you're looking at the gross profit margin in year 5 is the lowest. So it means that we can still make year 5 gross profit margin to be better. So yes, operating profit is, who can remind me, what is operating profit ratio? What's the formula? I want a female to talk now. What is the operating profit ratio? Yeah, I want a lady. I know ladies are very intellectuals, or are they shy or they are pretending? Or they've gone to bed? Which of the above? Okay, can somebody just help us because of time? Quickly.
EBIT over revenue. That's the.
EBIT,
Can you
that's
hear me?
profit before. Yes, I can. Profit before interest and
Exactly.
tax divided
That's
by
operating
revenue.
profit over total revenue.
Yeah, EBIT,
Yes.
profit before interest and tax, operating profits, you're all correct. So equals to operating profits divided by revenue. Yeah. So which year do you have a higher operating profit, or which year has better operating profit here? Which year has a better operating profit? I know a lot of you will say year 5, but
They
let's
still be
check
looking
with
at
our operating profit.
Year one. Year one could be, okay. It's year 3.
Okay, year 1 has the least operating profit margin, followed by year 5, then we have year 4, then we have year 2, and we have year 3. So the operating profit, now if you look at it from the perspective of gross profit margin is reducing. Gross profit margin of this company is reducing. So as a financial analyst, I'm going to advise them that it's not good that the gross profit is reducing. As revenue is increasing, the gross profit margin should be increasing also, not reducing. Then the operating profit ratio is unstable. From 20, it increased to 26. Then from 26 to 28 is increasing. So in year 3, it's like in year 3, the operating profit margin has reached its peak, but is now reducing back. It's going down from year 3. So in year 4, it reduced. In year 5, it reduced. So this is how you analyze the financials. Then there are other things you need to ask questions on to know how the company is performing. So the net profit ratio is actually the net profit divided by what? Net profit divided by what? Revenue. So we'll copy and paste also. Yes, the net profit, the highest net profit is in year 3. So we can see that the net profit ratio is aligning with the gross profit margin. It's increased from year 1 to year 3 and is reducing from year 3 to year 5. So good. So the tax ratio, who can remind us the formula for the tax ratio quickly? What's the formula for the tax ratio?
That's a tax.
Yes.
Divided by what's that?
Tax, income tax, that's your income tax. Income tax divided by profit before tax. Oh, sorry. Income tax. Income tax divided by profit before tax. Yeah, the formula is there. The formula was there. Where is it? Yes. Income tax divided by profit before tax. So that's it. So you just copy this formula and paste. Just copy this formula and paste. So what's the next thing? What's the next thing?
Interest coverage ratio.
Interest coverage ratio, good. Interest coverage ratio. What's the formula for interest coverage ratio?
Okay.
Okay, Ayodele, I can say ICE. I don't know what ICE means. Can you just tell us what you mean by saying ICE? Okay, what's interest coverage ratio? Okay, ICR. Okay, I understand now. ICR. Okay, interest coverage ratio is ICR. Yeah, you're correct. So what's the formula for interest coverage ratio? Anybody? Your interest coverage ratio is profits before interest and tax. Profit before interest and tax, which is your PBI, operating profit divided by interest expense. Yeah, the formula is there, operating profit divided by interest expense, which is EBIT divided by interest expense. Good. So that's your, so and it's telling you that your interest coverage ratio is, wow, interest coverage ratio is increasing. Is increasing. In short, in year 5, the increase was actually very, very significant. Yes, it was very, very significant. So, so that is that. Now, does anybody has a question? Does anybody has a question? I think we have the practical session. So I think this is where we're going to stop because I know a lot of people, you've had a very busy day, but let me see if there are questions. Let me get your feedback. Have you gotten any value from this masterclass? Has anything changed? Do you have question? So I want you to unmute yourself and talk. Okay, Ayodele Lucia, you said, what does that mean for the ICR increase? Interest coverage ratio is increasing. So what this means is that if you look at the interest expense is increasing actually, it's increased from year 1 to year 2 to year 3 to year 4, but it's reduced in year 5. What it means is that the profit the company is making is like multiplying, like ×2. Profit before tax, or let's say we were comparing operating profit. Operating profit was almost ×2 actually. 807 times 2 should be around 1.6. I don't know, Mr. Toby, please be on standby to share your screen. Please be on standby to share your screen. If I'm logged out for any reason, I think I'm having some network challenge. But if I'm logged out from any reason, so just be on standby so that I'll most likely change my network and continue the class. I think this network is not really okay. So yes. Mr. Toby, can you hear me, sir?
Yes, I can. I'm on standby.
Okay, good. Thank you. So yes, so that is that. So the reason why we have the interest coverage ratio increasing, or what can lead to the interest coverage ratio to increase, is because your interest expense is reducing. Is either your interest expense is reducing, or your interest expense is what? Reducing, that's the denominator, or your profit is increasing. So that's the reason. If your interest expense is reducing, it means your liabilities are reducing. But if you check, your interest expense was increasing for the first 3 years. Your interest expense increased, which means the liability increased. If your interest expense increased, it means liability increased. But from year 3, your interest expense was reducing. It means that your liability is also reducing. So good. And that's why we have exponential increase here. We have exponential increase between year 4 and 5. This increase was very significant. But if you look at what happened in year 1, 2, 3, even though the liability was increasing, but the increase in profits is more significant, or is of higher proportion. Does that answer your question? Wow, Regina, I can see your response. Yeah. Okay, we are so glad that you find the class interesting and educative. So yes, does anybody ask further questions? Does anybody ask further questions?
Yes, I have a question.
Yes, please go ahead.
Okay. Sorry that I'm using the finance manager. I'm connecting from my office laptop. That's why it's like that.
Okay, but what's your name, sir?
My name is Abiola. My name is
Oh,
Abiola.
okay, good. Mr. Abiola, it's good to have you on board.
Okay, so my question is, you mentioned when we were computing for that gross profit.
Yeah,
So as you can see, the gross profit is reducing from year 1 to year 5.
the gross profit margin.
Yeah, the gross profit margin, I mean, it is reducing from year 1 to year 5. So, what will be your advice to the company of these financial statements? when the gross profit margin is
What will I?
like what
I didn't get
what
that.
like how will you advise the company to increase the gross profit?
Okay.
Did you get the
So
question?
I think yes, I think I did. I guess your question. So what you are saying is that if when
What
you
should
check
the
the
company
gross
do?
profit, okay, good. So now, as a financial analyst, what I would do is I would request for the notes and say, okay, what gives us this gross profit is a combination of revenue and cost of sales. Okay, what's the breakdown of your revenue? Share with me. What's the breakdown of your cost of sales? Share with me. After I have gotten that, then I will ask them and say that, okay, if your revenue is this figure and your cost of sales is this figure, then it means that there is something in the cost of sales. So is either, okay, I can see that revenue is increasing, and I can also see that the cost of sales is increasing. But the decrease in the cost of sales is telling me that the cost of sales, now I'm going to put a ratio here. I'm going to compare the cost of sales with the revenue. Let me just call it cost of sales. So I'll compare the cost of sales with the revenue. I'll compare the cost of sales with the revenue. So the cost of sales here is 45%. Yeah, 45% in year one. approximately 44%. It's approximately 45% actually.
I can't see your screen.
Oh, you can't see my screen?
I don't know, maybe it's from my own end though.
Can others see my screen?
I can't see your screen as well.
Wow, let me stop sharing.
I can't see your screen too.
Wow.
Okay. So I guess Mr. Michael is experiencing a network issue. So Abel, if I get your question right, you were asking that why was the gross profit margin ratio, right? Why was it decreasing? Right.
Yes,
So even
yes.
though,
Why was it decreasing? And what would be
okay,
the advice to the company?
okay. So the main point is this: the cost of sales, right? The reason why the gross profit margin was decreasing shows that the company was not managing its resources efficiently. So if you notice it, that year one, we had about 2 billion in revenue, and then the cost of sales was about, I think, 900,000. No, 2 million in revenue, then 900,000. So if you look at it, year one, they manage their resources efficiently, but then year two, year three, year four, their cost of sales keep increasing more than their revenue was increasing. So the company was not efficient with its resources. That's why the gross profit margin was just decreasing. So your advice to the company would be that they should increase like their efficiency in their utilization of resources for the cost of sales, meaning they are spending more now than what they were doing spending in year one. So if Mr. Market comes up, we will try to look at the variable cost. So we look at the percentage of increase year on year of the cost of sales, and we look at the percentage of increase year on year of the revenue. I'm very
Okay.
sure that the cost of sales will be increasing way higher than the revenue. So
Oh,
that was the reason.
okay, thank you.
So do you understand now?
Yes, I understand.
Okay, so do you have any more questions? I would like to hear more questions. It shows that you guys are following the class. Omobolanle, Akachuku, Reginald. So who has question? Okpeyemi, Bisola, Adisa, Emmanuel, Jimo. Do any of you have a question? Okay, so in the absence of no question, I would like to ask us what was our takeaway like? What did we learn? What did we learn today? Like, what was the new thing that we actually learned today from the class? Because I actually have learned a lot of things.
Yeah, from my own end, the new thing I have learned is that financial statement, computation of financial statement is not just about the preparation alone, but about the analysis, how you can interpret figures, interpret numbers. Like for instance, the gross profit now, we can see that we compute different kind of ratios, like the gross profit ratios. And the asked us a question the last time that what was the like which of the company, which of the years is making more gross profit without calculating the ratios. We eager to pick the highest one, but the ratios, we now realize that it is even the company with the highest gross profit that is even making having the lowest ratio. So computing that ratio now make us to realize and have the make us to have an accurate interpretation of the financial statements.
Oh, okay. So thank you so much, Abiola. So we else have other things to contribute about what he or she learned today? Thank you so much, Modinat. Although we're almost done with the minute, if you can just wait. Oh, she has left already. Okay, so do any other person have any other contribution? Okay. So what I'll just say is that financial analysis, financial analysis is all about understanding the assumptions, the why you are doing it, not just understanding what, not just doing what you are doing. It's not just about computing the calculation. It's not just about computing the interest coverage ratio. It's about understanding the why. For example, that interest coverage ratio that we saw that it increased significantly, it was showing that the company has a lot of money to actually cover its interest payments because the company was increasing its profits and its interest payments was around the same rate. So it shows that the company has a lot of money, right, to cover its interest payment. So it's just understanding the why. We've seen big corporations that collapse because of lack of proper financial analysis. Not even lack of financial analysis now. It's because they don't understand the why. They just understand that okay, this is what we are doing, not actually the why that we are doing it. For example, like long-term capital management in the US, it was the biggest hedge fund hedge fund in US as at in the 1990s. But they created a lot of theory. They brought in professors to help them do their computations. But What happened was that they didn't understand the why. They will just understand the calculation behind it. They don't understand why we're calculating it. So when the financial crisis hit Russia in 2001, they lost all their funds because they don't understand the why. They just understand that, okay, if we're making higher, means that what our company is doing well, but about understanding the why. Okay, for example, next week Tuesday on the 24th, if CBN decide to reduce the interest rate, that's in Nigeria here. So how does it impact my business? How do I position myself? How do I make sure that my company is battle ready for whatever decisions the CBN make? Because if you understand economics, you understand that micro is the microeconomics, is the micro part of economics that makes up the macro, right? It's the, it's the micro that makes up the macro. So even though you are saying that, oh, okay, CBN is too big, it won't affect me. There's not it won't affect you. When the exchange rate fell, right? That's in 2023 and early part of 2024. It affected everybody. It doesn't matter if you're a small business or a big business. It affected everybody. So right, it's not just understanding that okay, we know how to calculate, we know how to compute. It's not about how fine your model is, right? It's about the in-depth. Well, Mr. Michael has joined us back. So Mr. Michael, welcome back. Can you hear me, Mr. Michael? Okay, this network that is having issues. So as I was saying, is understanding the why, right? Okay, inflation rate, what is it now? And what is it going to be in the next one, in the next month, because the cost of goods is rising, mean that your
Okay,
expenses is
yes,
rising. So
Mr. Toby, thank you so much, sir. I can hear you now.
nice to
So
have you
sorry.
back.
Yeah, I was having network issues. So sorry, guys. So it's good to be here back. And I think I've been listening to the conversation all along. And I also enjoy what Mr. Toby has been explaining so far. Yeah, thank you. Thank you so much, guys. So have we been able to attend to questions?
Yes, we have. Unless maybe they have another new question, or we'll be able to attend the question that.
Okay, so yes, are there other questions? Let's attend to them before we call it a day. Okay, I know Mr. Toby was saying something. Maybe I should give him time to round up what he was talking about before we move to the next session. So yes, Mr. Toby, you're trying to say something. So let me just allow you to round up that point.
Okay, so I was just talking about the interrelation of everything in when it comes to finance, when it comes to the economy. So there's no like one place is isolated. Even if you look at the global financial crisis in 2009, right? So what caused the financial crisis was just housing in the US, mortgage house in the US. So banks were just giving out a lot of loans, right? People were happy. People were buying it. They were not looking at the implications. Bank were giving out a lot of loans for people to build houses. And the bank were like, okay, we're fine with it since by the time we build the houses, they'll be paying us back little by little. So they packaged it into a mortgage backed security and start selling it. But when there's a lot of supply in the market and there's little demand, because everybody now has a home, right? Nobody is paying mortgage, nobody is really looking for home anymore. So that's what caused the financial crisis in 2009. And funny part is that it affected only US housing market, right? But it went globally because a lot of people were invested in it. So there's an interrelatedness, there's an interconnection between everything we do in finance. As one, just like if you make a sales, right, it is affecting your P&L accounts, meaning that your sales minus your cost of sales, it will affect your balance sheet, meaning that if it will affect the cash in your balance sheet, and if the person didn't pay fully, it will affect your receivables. and to affect your cash flow. So everything is just interrelatedness. So it's about understanding where does it affect, how does it impact the remaining. So that's what I want to say about financial analysis. It's a very interesting topic, very interesting course.
All right. Thank you, Mr. Toby. Thank you so much for that addition. So, yes, just like what Mr. Toby has said now, financial analysts will be able to make the numbers talk, will be able to connect the dots between the financial position, the financial performance. So, yes. So that is that. So I think there are no questions. Mr. Toby, please can you continue to share your slide? I think there are other things we need to talk about on the slide before we call it a day. So I actually have an offer for everyone that's still here on this call till this moment. So by the end of this class, can you just go to the next slide? The next slide. By the end of this class, okay, yeah, it's fine. No. The first, the previous slide, please. So by the end of this class, I will give two people the privilege to talk. So just give us feedback. This is the first time you are joining a boot camp from Plus Business School. So just give us your honest feedback about what you feel like about this symposium. So yes, as a feedback to us. So because we really want to know whether people got value. So just to prepare the mind of us. So you can just indicate by raising up your hand if you want to be the one to talk. I want a male and a female to do that. So once we get there, you can raise up your hand now so that I will then give the people the privilege. So you can just raise up your hand before we end the class. We're almost rounding up. We're almost rounding up already. So Plus Business School is organizing a, I believe you all enjoy this class, even though we don't have much time, but we're also trying to manage the time we have and to ensure that we pass value, we give out value to people. So Plus Business School is organizing a master class in October, starting from October 1st. And this masterclass will walk you through the financial analysis. It's a 3-month intensive training. So what we have just done here is a tip of the iceberg. It's a tip of the iceberg. And at the end of the training, you're going to get a certificate from Plus Business School. Yes, you're going to get certificate from Plus Business School that shows that you are a financial analyst. Yes, the certificate is going to be a recognized certificate that you can use to work as a financial analyst wherever you find yourself. So it's a 3-month intensive training. It's a 3-month intensive training, and the price is actually, in short, it has been discounted to 200K. But because we have a lot of people that have taken their time to join this training and have gotten value, we'll be giving 50%, we'll be giving 50,000 discounts. Be giving 50,000 discounts for anybody on this call that want to take advantage of the discounts. The discounts is open between now and tomorrow. So instead of paying 200,000 for this masterclass, you can pay the sum of 150,000. So this masterclass is not just about the money, it's about the value. Yes, but we know that if we make it free all through, people may not take it serious. So we only need few people that will take things very, very seriously. We need just few people that will take things very, very seriously. And at the end of the day, they're going to get the skills. So the tools we'll be using are Excel, Power BI. Yes, we will also be talking about how to use Power BI to build financial models. So yes, so and also at the end of the training, you're going to have access to so many templates, industry reports, and the like. So the course is divided into 6 modules. 6 modules: foundations of financial analysis, financial ratios and performance metrics, things will be broken down step by step, forecasting, projections, and financial modeling, investment and valuation analysis, investment and valuation analysis is the fourth one, financial analysis using real tools, applied financial analysis, and professional development. Yes, you can see that we've talked about the earnings of financial analysts globally, and you can even get a remote job with a UK firm or a company out there in the global north that will pay you in dollars in the USD as a financial analyst. So when you have the skills. So this training is actually for all financial analysts and accountants, people into corporate finance and FP&A, professionals, investment analysts, as well as business valuation consultant. Then we also have MBA students or professionals, whether you are a BSc holder, you want to transition into finance roles, you can also register for this training. So yes, we have 50,000 discount available between now and tomorrow. Tomorrow is Thursday. By Friday, the price goes back to 200,000. So yes, that's the price, even though this price has been discounted. So yes. So I think that's just all we have for you guys, except if there are questions. If there are questions. Sorry, who is talking? Is anybody saying anything? So is there any question, feedback, comments before we call it a day or draw the curtain? I think nobody has a question before. I think we have 25 minutes more. So if you just want to, if you want to ask questions based on what has been said about the master class, or you want to ask questions based on what has been discussed during the boot camp, feel free, ask your questions and we'll attend to them.
See you finish this one, take that. What did you?
Sorry about the noise, Mr. Abel, you're in a noisy environment. So anybody who is talking, who is saying anything, this place is too quiet.
So that's the one that's it.
Yes. Any question, any question? Okay, nobody has a question. All right, so I don't know if Mr. Toby wants to add one or two things to what has been said so far before we draw the curtain. Yes, Mr. Toby. Now, as I've said, Mr. Toby is actually a finance expert and he works with one of the big four accounting firm. So he's also one of our key person here at Plus Business School. Plus Business School has a tutorial center in Mowe Bafo area, that's Pakuro. ICANN tutorial, CITN exam, and other professional exam that you might be interested in. We also organize training for corporate companies. For companies, we organize corporate trainings on financial analysis, on QuickBooks, on Excel, and other trainings. So yes, so I don't really like the fact that we're not getting feedback from students, questions, contribution, addition, subtraction. So I said, I want two people to talk at the end of this training, at least just to get feedback from what we actually gain. Do we really get any value from this class? I understand the fact that we started around 8. This is almost 2 hours. Have we gotten any value from this? Should we do something like this? So this will be able to tell us, okay, should we organize a boot camp like this again in the nearest future? Because we have plans of organizing something like this in the nearest future. So yes, so that's the whole essence of the feedback. So yes, let's take feedback from 2 people before we draw the curtain. Yes, who is leading the floor? Finance manager, let me hear from you, sir. I think you were the most active person in my practical session. So have you gotten any value from this boot camp?
Good evening, sir.
Yes, good evening, sir.
I want to say thank you for this opportunity. I really appreciate, and I have really gotten value from this class. Most especially the financial statements, the financial ratio, how to analyze it.
All right. All right. Thank you so much. Thank you so much, Mr. Finance Manager. So yes, can we have somebody else, a female now? So at least before we draw the curtain, we want to get your feedback based on, did you learn any new thing from this masterclass, from this boot camp? I guess a lot of people are shy. They want me to call names. Madam Bisola, can you talk? Let's just hear your feedback. Did you get any value from this class? So please unmute and let's hear from you also. Oh, Mr. Yogbile, I saw your message. Okay, yes, I can see that you got value from the boot camp. So that's a good one. Yes, Madam Bisola, we are waiting for you.
Yeah, the class was very educative and straightforward. And yeah, I can say that it was a fantastic time spent on the call. Well done.
Yeah, thank you. Thank you so much. So
Thank you.
yes, yeah. So we have so we'll be having other free trainings that will be coming up. And so on that WhatsApp group that you belong to is part of our community. So you can still be in the loop so that if we have further trainings, free trainings that you can enroll for, we can always reach out to you there. And if there are other tips, or maybe you need one of us to attend to 1 or 2 things, we can always feel free to ask questions about finance and all that. So yes, on the WhatsApp group. Then for as many that are very interested in the financial analysis masterclass, I want to get the discount. The link is Mr. Emmanuel on this call. Mr. Emmanuel Adekoya, our media person, is he on this call?
Yes, I'm on the call.
Okay, good. So, Mr. Emmanuel, please help us drop the more details about the master class at the end of this training, so that people that want to register for the financial analysis masterclass, the 3-month masterclass, can do the needful and take advantage of the discount that is ending tomorrow. So yes, thank you everyone. Thank you everyone for joining the call. It's actually a very good time spent. Mr. Toby, our host, I would be handing over to you right now.
Okay, thank you so much, Mr. Michael, and thank you everyone for joining this call. I've had a wonderful time. It's really nice to hear your opinion. So over the few hours we've spent, we'll be able to unpack, we're able to learn about financial analysis, ratio forecasting, analyzing ratios and the likes, right? So what I just want to leave you with is that I will encourage you to learn and apply what we've learned today. So I will encourage you to learn too, because practice makes perfection. So you can't just get everything one day. So, but as you keep practicing every day, financial analysis is very easy. You can just pick up a financial statement of a company, right, and try to like forecast, okay, how is the company doing? Let me even check the financial health of the company, right? We are here to guide you. You can always message us on that group, right? And ask any question you want to ask, right? We always answer you. So thank you so much, everyone. Thank you for joining. It has really been a wonderful time with you guys. I'm hoping I will see you guys at the training, right? So thank you. Thank you all for contributing. We've come to the end of today's bootcamp. Thank you.
Thank you.